I'm Laura Gieseke. I'm the tax attorney at SMB Law Group. I started with the firm about, I guess, 10, 11 months ago. And this is Will.
I'm Will Hodges. I'm a principal for Hancock Askew, and I lead our tax advisory practice. So do a lot of deals, a lot of tax consequences of those deals. And then we also are some of the few people that take on after that and do the returns and all that fun stuff.
Yeah. Okay. So we're going to start just very basic stock versus asset acquisition. This is often the first tax impact question that you're going to have when you're looking at different acquisitions. Okay. So most of the time, as a buyer, you're going to want to buy the assets. Does everybody know what I mean when I say you get a full step up in the assets? You'll hear that language a lot. Basically, what it means is you get to book on your books the full fair market value of each of the assets that you bought and depreciate or amortize those over time. So generally, from a tax perspective, is your best result. However,
There's an exception.
going to generate ordinary income to your seller. A lot of times the seller is going to have a visceral reaction to that because you're going to have a gap between capital gain and ordinary rates on those assets. It's not always the case, especially if you're buying something that's mostly goodwill, but generally speaking, that's going to be the case. The biggest hurdle you're going to come across with an asset acquisition is that every single asset has to be legally transferred. And so you'll sometimes end up in a situation, and we've seen this tons, where you've got certain contracts, government contracts are particularly bad about this, where you really need to buy the stock in order to make the business make sense to purchase. So I'll let Will talk about.
Yeah, I mean, sellers love stock deals because, as Laura said, we're minimizing the amount of ordinary income that sellers are going to be able to recognize in those types of transactions. Everybody wants capital gains. Everybody believes that when you go sell a business that you're going to be able to recognize capital gains. Some of the hardest conversations I have with sellers in the middle of doing deals, if we don't explain to them on the front end what their tax bill is going to look like, it just tears everything apart down the way. I'm kind of in the middle of that situation.
If they're selling a C Corp or an S Corp, less so. But if they're selling out of a partnership or an entity taxed as a partnership, they're going to have some ordinary gain because of depreciation recapture. That's often a surprise to people. Yeah, so having this conversation on the front end can be really key.
Yeah, I think it's massive. Yeah. And it's not always the tax situation. When there are definitely situations we get into where a stock deal, you need to do it because we have some type of contract, to Laura's point, that needs to be transferred over. And it's just a whole lot easier to transfer that if you're just buying the business out or buying the stock outright and keeping that entity in place, as opposed to, buying the assets and trying to set up some new type of entity.
And there are tax strategies we're going to talk about if you do feel like you really need to buy the stock. There's some tax strategies we can implement to get you a step up in the basis depending on the structure of the transaction. It's just not quite as easy. But then there are due diligence things you need to think about that are a little more intense when you're buying stock that we're going to talk about a little later as well.
Hey, so when you guys are doing the documents and you've got the asset deal, because you're transferring you have to transfer all the assets, right? Is that harder to do the documents for an asset deal or a stock deal?
I mean,
does it vary?
It just depends.
Yeah. Okay.
Yeah, it depends on the business. You had a question. So we're going to talk about those. We're going to get there. So that's something super specific to buying an S corporation. So we're going to talk about that.
And if y'all have questions along the way, please.
Yeah, we want to keep this conversational.
Please.
I know that this is, somewhat dry for a lot of people. We were talking about it outside. I was like, look, we may be nerds, but you need us. Yeah. So just going into it with that. So choosing your entity. So a lot of times, this is the first thing people ask us, what should I be? Should I be a corporation, LLC, partnership? Most of the time, forming an LLC for yourself is going to make the most sense, particularly if you're self-funded. It's not always the case. If you're bringing in investors, you're generally going to want to be in an entity that's flow through, taxed as a partnership. S corporations can make sense in limited situations. They generally don't make sense when you're bringing in other investors. We're going to talk about that a little more as well. Can you go back one, please?
Yeah, I'm trying to.
And then you want to talk about C Corps and when they actually make sense?
Yeah, we're going to take a deeper dive into this as well. But back in 2018, when we had tax reform, Congress was trying to equalize the rates. And we did a lot of choice of entity analysis at that point because we had private equity firms were looking at their various investments. And kind of what we figured out at that point was, hey, if we are If we're going out and reinvesting our earnings back into the business, it makes a whole lot more sense to be operating as a C corporation because there's less tax leakage on that, right? So if I have a 21% rate as opposed to, maximum 36% rate on the flow through side, I can deploy a lot more capital annually if I'm paying less in taxes, right?
Let me explain that. Let me back up a little bit and give you guys a forest for the trees. So if I'm in a disregarded entity, a solely owned LLC, or in a partnership, all of the items of income of that entity are going to be allocated to me on my personal return. In a partnership, I'm going to get a K1. Sole LLC, it's all coming to my own 1040. That means that no matter what I do with the cash that business generates, I'm going to pay income tax on the entirety of the income that business earned during the year, whether I redeploy the cash in the business or take it out of the business. It can create some pain for people who are trying to reinvest all of their profits and build their businesses because you're paying income tax and you're not taking any cash out to make that make sense. So in a C corporation, yes, you pay a corporate tax of 21%, but you don't pay any tax personally until you take a dividend from that entity.
Right.
Okay, so check the box regulations. So I wanted to talk about this before we talk about S corporations. There's a difference between the legal classification of an entity and the tax classification of an entity. The check the box regulations, for example, if I've got an LLC, it's going to be disregarded as separate from its sole owner. The IRS doesn't even see it. It doesn't file its own return. Same thing if you've got a C corporation that owns a bunch of LLCs. IRS doesn't care. They're going to treat it all as owned by that single C corporation. I can change that classification with a check the box election. These come in really handy when we're doing reorganizations. So when we say check the box, or this is what we're referring to. And this can be a QSBS play, which is why I wanted to mention this. So let's go to the next one. All right. So state law entity types: C corporations, limited liability companies, and partnerships. We don't use state law partnerships a ton. Most of the time when we're referring to a partnership, we're referring to an LLC that has multiple members. The default classification under the code for a multiple member LLC is as a partnership. You are a partnership for all purposes. So if I say partnership, I'm referring to both state law partnerships and state law limited liability companies with multiple members. And then C corporations, again, they pay tax at the entity level. All, their items of income, credit, loss deduction are computed at the entity level. That is not true of an LLC and a partnership. Some states do impose entity level taxes on LLCs, some do not.
Yeah, and I think to further your point on the limited liability companies versus the partnerships, and our good friend Kevin Henderson's state of Texas, you still see a lot of real estate deals done in limited partnerships because for franchise tax purposes, you actually are able to minimize, you got a little bit of tax play there, but you have to be set up as a limited partnership. But like 90% of the time in this day and age, we see LLCs that are taxed as partnerships.
Yeah, they're easier from a governance perspective. That's why. It's just state law governance reasons. There's really no other reason.
Yeah. And so when you're setting these entities up, I think you have to be really cognizant of the business objectives and what you're trying to do with the cash that you're generating in the business, as well as what the tax treatment is ultimately going to be. Tax should never be like the sole factor, in my opinion.
Agreed.
I'm a tax person, and it should never be the sole factor of what you're trying to set up.
And I think most tax people will tell you that tax shouldn't wag the dog. That's the phrase everybody uses.
Yeah.
So a C corporation, most of the time that's not going to make sense unless you're going to try to take a company public. You're going to generate a ton of loss on the front end. So it's more startups that are using them, or if your business qualifies for QSBS, which is we're going to talk about a little later.
And then we see a ton of LLCs.
Yeah, I would say 90% of what I see is LLCs.
And then LLCs and these
S corporations. Okay, so an S corporation is not a legal entity type. You will see LLCs that have elected to be treated as S corporations and C corporations that have elected to be treated as S corporations. And an LLC that has elected to be treated as an S corp has technically made two elections. One to be treated as a corporation under those check the box regulations we talked about earlier, and another to be treated as an S corp. So you come across these, they are subject to a lot of limitations in terms of who can own them. You cannot have more than 100 shareholders. They have to be a U.S. resident. Has to be an individual. You cannot buy into an S corp with an entity, and that's where we come across most of our issues and deals, because people have an investment entity. They've got 3 or 4 investors. They want their partnership where their investors are sitting to buy into their new business. If you buy into that S corp, you're going to turn it into a C corporation. That's where we come in. That's where reorg comes in. You were asking about. So we're going to talk about that a little later. But the main thing with S corps that make them tough is you cannot do anything that isn't pro rata among the owners.
Right. No flexibility. So
Yeah.
if you're bringing in investors and somebody wants a preferred return or they want different economics than what you're normally giving out proportionate to the shares that everybody owns, really difficult, actually impossible to accomplish that
Well,
accurately.
if you do it,
inside of
you've now
S
got a
corp.
C corporation,
Yes.
and you may not realize you have a C corporation. Then you go to sell your business, and 5 or 6 years later, somebody's doing diligence on it, and they find it, and it's
I think
no one's happy when that happens. But you can inadvertently create a second class of stock in an S corporation fairly easily. This is the situation you really don't want to pull an agreement off of LegalZoom and hope for the best.
Right. Yeah. Yeah, I had a colleague I used to work for or work with in the National Tax Office of a public accounting firm, and his joke was there are only C corporations and C corporations that think they are S corporations because they all ultimately end up busting their S elections at some point in time.
Yeah,
just inadvertently.
The IRS is pretty generous about relief if you catch it early enough, but like that's just not a game any of us want to play.
Yeah.
Okay.
Yeah, and it is a diligence thing though, too, because one of the big things
Yeah.
that people look at in tax due diligence is if you have a valid S election in place, because that can create some curveballs later on down
things
the road.
as simple as a spouse in a community property state failing to sign the initial entity form 2553 to treat you as an S corp will cause it to fail technically. Those are easier to fix, but they are technical failures.
Yeah.
Okay, so structuring your acquisitions. Since you're going to come across S corporations a lot, I really wanted to talk about this. So I really like reorganizations for a few reasons. First off, it makes it much easier for you to buy into the entity and get a step up in tax basis. So what you do, S corporation, this is a really simple example that's got an S corporation owned by a single individual. So that S corporation target, the triangle indicates that it's a flow through entity that has nevertheless elected corporate treatment. It's going to form a new S corp. It's going to contribute the existing S corporation to the new holdco, S corp holdco, and then it's going to file either an election under 8832 if it's already an LLC, or it's going to convert for state law purposes to a disregarded entity, to an LLC for state law purposes. And this is actually something got deleted, but it should have the S corporation holdco over the target. So the S corporation at the end of the day, there's going to be an S corp in between that target and the individual. So essentially they'll end up holding their old target through a new S corporation. When they file, there's a filing under the code 8869 that causes that new LLC to be treated as a qualified subsidiary of the S corp. When you make that election, technically speaking, all of the tax attributes of that old S corp belong to the new holdco. Does a couple of things. First off, you've got a disregarded LLC. So when you buy a disregarded LLC, you are treated as buying assets, even if you buy the equity for legal purposes. So you can buy all of the membership interest in an LLC, but if it's disregarded, it's a tax asset acquisition. Great answer for us, right? The best thing about it is you're no longer beholden to the seller's S corp treatment. You get a fresh start, blank slate. You aren't dependent on that. If you make a 338H10 election, which a lot of people like to talk about when buying an S corp, because it's a way to buy the S corp and treat it like an asset acquisition. If it turns out later that the S corp election of the seller was bad, you no longer get asset treatment. Your 338H10 is dead. So I prefer doing this. Sure, yeah. Mm-hmm. Okay. Yes. Yeah. Mm-hmm. And a lot of times you might have 100 contracts and they might all have different consent provisions. You might have to go get permission from a whole lot of people to transfer each of those contracts individually. It can make it prohibitive. They're going to say no. Yeah. Yeah. Mm-hmm. Mm-hmm. Yeah. The only way, yeah, the only way you can buy into an S corporation directly as a searcher is if you buy as an individual. Yeah. And a lot of times, most of the time, people don't want to do that. That's inconsistent with their broader goals. So, an F reorganization essentially allows us to reorganize that S corporation into an LLC that it's treated as an asset acquisition only for tax. It's an equity acquisition for every other purpose. So, all those contracts that you need to transfer, same as a stock deal. Yes.
Yes, that's exactly right.
Yeah. Yes. And I was going to say
Right.
my
Exact
third
same thing.
favorite
Yeah.
benefit is the EIN doesn't change. So if you've got payroll and things at this entity that you want to continue, you don't have to change any of that. That can be really useful for things like 401k plans and health insurance and all that kind of stuff if you've got a bunch of employees at the entity. The other nice thing about doing an F reorganization is if you're doing a partial rollover. So you can actually have the S corporation. Yeah. So this is what it would look like at the end of the day. So this S corporation that the sellers will own after the F reorg. So when you buy in, you can buy 80% of that entity or more. It doesn't matter. The percentage does not matter in this case. They're treated as contributing 20% of the assets to the new company, and you're treated as purchasing 80% of the assets of the new company to form a new partnership. So it's a way to facilitate rollover equity while getting true rollover. If you make a 338H10 election, it's 100% taxable, even if they only sell 80%. Mm-hmm. Mm-hmm. No, you still need to diligence that.
You'd still
And
have that. Still
and
be an
there are
issue.
states like California, especially, where they will take the position that first, even in an asset deal, California will take the position that if you've bought all of the assets, you have successor liability on the sales tax. And so that actually isn't that different. Like if you're buying all of the assets of a company, I would still make sure from a state and local tax perspective, you've done your diligence on that.
Successor liability is always the fun one when you're doing due diligence, right? Because everybody wants to know what it is that they could possibly be stepping into. That's
Yeah.
when we can start talking about reps and warranty insurance and all that fun stuff.
Yeah, and that's probably beyond the scope of this particular presentation.
I think the one thing I'd add to this too, Laura, I got you hit on a second ago, is when we set up this LLC, the target now is a partnership between the buyers and the old S corporation. But the buyers truly are only going to get depreciation off that 80% that they bought.
Yeah,
The
you only get a step up to the tune of what you bought.
Right.
In cash.
The 20% is a deferred gain that's going to stay with the seller and either unwind through special allocations over time or stay around until we dispose of the business.
But this is a great result for them because they don't have to recognize the gain in the assets they're deemed to have contributed to this. So if you're doing a rollover, this is a really convenient way to do it out of an S corporation. It is going to generate more tax in most cases than them selling the S corp across the top. But my response to that is usually, okay, but who are you going to sell it to? Because everybody you try to sell it to is going to have the exact same issue I do.
Yeah.
Mm-hmm. Yes. Yep.
Yeah.
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 Yeah, and that's where we come in.
Yeah.
That's what we're here for. I just suggest having those conversations very early.
As soon as you can. Yeah.
Yeah.
And Kevin, I think that's a good point too, because these partial rollovers are relatively new in the SBA space, right?
Exactly.
And so it's one of those deals where yeah, right. And it's a
Bingo.
lot of conversations that need to be had early on in the process to mitigate any potential issues down the road.
I have a question. Recently, there's a searcher looking at a plumbing deal in New York, and the seller was going to roll equity. Seller had been misquoted. And they told me they talked to two tax attorneys, and they're debating QSBS. And one tax attorney said, you have to figure this out pre-close. The other one, I believe, figured it out post-close. surprised you were like very different answers. I don't know if maybe just one was recommended like for your closer. I don't know like your thoughts on that, like if you can select, you know, and go for QSBS.
So going from an S corporation to a C corporation for purposes of QSBS is one of the more complicated things you can try to do in terms of reorganization. So maybe we talk about that outside the scope of this presentation. I would actually reorg that entity and then do a new C corp because of the potential issues with that. But we can talk about that later.
You ever see them do that post close? Like just
I've
I've never heard like that recommendation on doing that post close. Most of the time when we do these pre-restructuring transactions, we're trying to do very specific things to get it in a place that we need to get it into before we effectuate the transaction.
And let me back up and say one thing. You cannot do the reorg post close. Just in case that wasn't clear. The QSBS structuring is a different question. The reorg has to happen pre-acquisition.
And the best way to work as searchers, all we're really trying to do is issue spot.
Yes. That's right.
So like one of the things you should add to your question list for that first call with the seller or with the broker is the target company an S corp? And that's what sends you down this route.
That's right. And I've seen SIMs where the S corp wasn't disclosed or it was buried in a footnote and the potential buyer didn't understand that it was an S corporation until we saw the SIM. So it is definitely something that's not a broker will not necessarily think to tell you.
And then maybe from there, the issue you have is if you discover this 2 weeks before close, it's a problem. And the seller is using his or her divorce lawyer to do their deal. And you say something like reorg to that divorce lawyer. Totally.
Yeah.
So
And again,
the close date
if you've got a business where you're doing an asset deal, you don't need to worry about this. This is when you need to buy the stock, but you're dealing with an S corporation. So yeah, a couple of things have to happen for you in this position.
So then all the way back, why would you ever not do assets? Why would you choose a stock
The
deal?
reason you would choose a stock deal is for non-tax reasons. You've got you've got something you can't transfer in an asset deal because you need some kind of consent that you can't get, or you have hundreds of contracts, each of which have consent provisions. It's never going to be a tax reason that you're going to buy stock.
It's almost always some sort of government contract.
Yep.
Or customer contract.
Or customer contract.
So what about the situations where you're able to, like, let's say you got $150 million, right, and you have to transfer this part.
F-reorg.
Yeah, I mean, if it's me, I'm just like, what are you gonna do? But you can transfer those individually. It's less fun, but it honestly just depends on how much pain you can tolerate on the asset transfers.
Did you do that?
Yeah, not 150 vehicles, but a lot.
Yeah,
If you could go back, would you do it the same way?
I would, yeah.
yeah. I mean, both ways have their pros and cons. So we did an reorg recently that confused the buyer's bank to a point where we've had multiple hour-long phone calls explaining that, yes, you do get to keep your EIN, and here's the regulation that shows that. So there's an education process with this on both ends, pre and post. And sometimes even large banks that should know better will surprise you because you'll get one person who's never seen it before and they just draw a line in the sand and they want to say no and they don't want to deal with it, and you have to escalate it, and it can go sideways quickly.
You can talk about like how this tax work with the reorg. So there's a deal going on now actually where SMB laws ratify or don't help me with that. And there's some huge tax implications, just super high level.
So he's referring to a somewhat of an unusual situation. The seller, there are four owners of an S corporation. 2 of them are not exiting. 1 of them is partially exiting, and 1 of them is fully exiting. When you do the F reorganization, the S corporation holdco is the seller. Because of the way S corps work, when they sell that business, the cash comes into the holdco. And as we talked about earlier, you cannot have disproportionate distributions out of an S corporation. So now I've got 4 people who are going to be allocated income in proportion to their interest, but 2 of them are not getting any cash, and 1 of them is only partially getting cash. They are not happy because they're getting hit with income on their personal tax returns and they're not getting any cash to pay their taxes. And so that's a really difficult problem to solve. There are some things we're debating doing, but at least as of right now, they're not moving forward.
When you have investors and you want different economics, stay away from this.
Yeah, and we're going to talk about when you want to issue equity to employees. What they did was not what I would have done had they come and talked to us beforehand.
So, if you're buying an S corp, you want to leave them equity,
Mhm.
and you just want your agents to reissue that equity, or does it have to be a separate situation?
So you can create a completely new entity and do all
Yes.
this stuff. The issues that you're going to run into is what Sam was alluding to earlier and what we've been talking about on the contract side
Yeah,
of trying to keep.
you're basically back in
Yeah.
asset transfer rules when you do that.
If you don't worry about any of that stuff, then yeah, you can start with a clean slate
Yes.
and go not worry about the reorg, set up an entirely new entity and pull it together that way. Yeah.
So if I want to,
Yeah.
if that's file, we want to give them 15%,
Mhm.
would it be easier to just create an entity rather than?
Well, if they're willing to sell you the assets. Yeah, I mean, I guess gating item number 1 is, can I do an asset deal? And if you can, you don't have to worry about any of this stuff. Yeah.
So from seller's perspective, how difficult it is to do asset transfer versus equity transfer?
You're talking about just from a pure like document perspective?
Seller's perspective, yeah. So from buyer's perspective, we always prefer to do an asset transaction.
Yeah.
So what type of resistance we will find if we talk to this?
Yeah, seller's going to want to normally do a stock transaction just because the amount of gain and the taxes they're going to pay are going to be lower. But what we do see is we see situations where we'll do a calculation on the gross up for how much additional taxes will need to be paid in an asset transaction. And then it becomes a negotiation point of if the buyer wants to pay an additional amount. Because it's a little bit of a game that we're playing in that when the buyers are buying, more of these ordinary income assets, they're going to get a depreciation deduction off of it. And right now we're dealing with bonus depreciation rules, looking at 80 to 100% of writing assets off, as soon as we get them. And so when people start running those cash flow analysis, they can get a benefit for going ahead and paying, additional money on the front end to the seller to be able to effectuate that type of transaction.
But if you do this at reorganization, it's going to be taxed like an asset deal. So that's where that calculation comes into play.
Yeah, those are good questions. I'm just glad everybody's still awake.
We've scared them enough. Okay, so we've touched on this a couple of times, but just bringing in investors and what effect does that have on your structure? Generally speaking, investors are going to want some kind of preference. Can't do that in an S corp, so that puts us in partnership world. We can specially allocate items of income, gain, loss, and deduction to properly reflect the economic relationship of the parties in a partnership. I'm the one that drafts that, and then Will's the one that executes it. So I have to make sure that what I write makes sense to him as they're doing the returns going forward and doing your books.
What you write makes sense. I've seen a few that put that right.
So there's also securities considerations that I'm sure have been touched on in other panels that you're going to have. You cannot just go advertise that you're raising money. Just keep that in mind. There's not really a tax effect there. I just want everybody to be aware of that. And then operational considerations. Again, this isn't tax necessarily, but all of this stuff is negotiable. How much you give to someone, what their preference is, how much voting rights they have, what they have the ability to prevent you from doing or force you to do, whether they can force you to sell. All of those things are completely negotiable in a partnership, and that's so. I used to say in a partnership, if you can draft it, you can have it. That's what I like about them. As corporations are severely limiting by comparison.
Yeah, I think the one thing I would add here, Laura, is when we're talking about the allocations for preferred interest, it's really important. We a lot of times we have a waterfall and we're either paying out preferred return first and then limited
We need
partnership.
to explain what waterfall means.
Yeah, is everybody familiar with the economics of basically how we're going to distribute cash, right? At the end of that, if we've got a big pile of cash, we've got these tiers of waterfall that we have to work through.
Yeah, waterfall technically says if I liquidate this entity tomorrow, who gets what?
Yeah. And so a lot of times you're going to see, preferred return in the first tier, return of capital to the LPs in the second tier, or vice versa. And the way that is written is actually extremely important, not only from just like a pure economics perspective, because you can change literally how your investors are going to receive their return, whether they're compounding on, a preferred that's accruing or not. But the other side of the equation is from a tax allocation perspective, most of the headaches that I have working in partnership tax and talking to attorneys and clients is when they write an agreement and we have a situation where the entity is operating in a loss, but I have to make an income allocation to the preferred investors because of the way that these waterfalls are. And so it becomes extremely important as you're going through this to talk to Laura.
I was
and
like, you
make
don't need
sure-
to know
Yeah.
anything other than please don't draft this waterfall yourself.
Yes.
That's all we're saying. Like, just get an attorney.
Yeah, because it's one of those phantom income issues that people hate to get allocated income surprisingly and then not have any cash to.
I know, it's shocking that upsets people, right? Okay, so we'll touch on QSBS a little bit because I do get lots of questions about this. So Section 1202 is a permanent exclusion on capital gain. It's up to 100% of the gain from the sale of qualified small business stock. It's up to 10 million or 10 times the adjusted basis of your initial investment, whichever is greater. Few quirks with this. Only works for certain types of businesses. Has to be an original issuance of stock. You cannot go buy a C corporation and have that stock count as QSBS. It has to be a new C corporation that was you received the stock in the original issuance. There are some asset requirements. Has to be below a certain size. But you have to hold stock as QSBS for 5 years. Some of you may be familiar, like if you run an LLC for 10 years and contribute that to a new corporation, your holding period will tag for purposes of whether the sale of that interest is capital gain later. It's not true for QSBS. That QSBS clock starts when the C Corp stock is issued. That surprises people sometimes. And then, so why doesn't everybody do this? You have to sell the stock. You cannot sell the assets out of QSBS. And as I'm sure all of you are looking for businesses, you're looking to buy assets for the most part. The same is going to be true when you go to sell, usually. Business has to be carefully managed to make sure you actually fit the requirements for the entirety of the 5-year period, the entirety of your holding period. And so there's ultimately, you have to have some investor tolerance that you may not ultimately qualify for that exclusion. However, in terms of investors, you can have a partnership invest in your corporation, and each of the partners will be entitled to the exclusion. So it can be a really good deal.
I think we have like 10 minutes left.
Okay,
Do we
so,
want to do Q&A?
or do we want to go through, like,
Or do you
do you want to take through? Okay, so we've talked about how allocations and cash distributions are the same, and Okay, I do want to talk about this really quick. So I frequently have people tell me they want to issue equity in their new entity to compensate a CEO or an employee or maybe somebody from the seller side. If you are taxed as a partnership, and again, this is another one of those things where you don't need to know the nuances of this, you just need to know enough to know that it's an issue. If you have somebody who has an ownership interest in your entity and you are taxed as a partnership, they cannot be a W-2 employee of that entity. Easy to fix, just have to know about it on the front end. We set up a whole payroll structure underneath the partnership to employ everybody. And that way your equity issuance and your W-2 payroll entity are not the same for tax purposes. You can really cause problems with things like health insurance plans, 401k plans, and all that.
Yeah, pretty quick. This is a big issue that we see very often.
Okay, and then this one. You're bound by your form, the IRS isn't. So
TikTok slide.
yeah,
All the
this is
advice y'all
TikTok.
get on TikTok.
Yeah,
Here you
the
go.
guy's telling you that you can deduct your brand new G-Wagon. No, you are bound by the structure you choose. The IRS isn't. So if they decide that in reality something looks like it happened a different way and it generated a different tax consequence, they will recharacterize the transaction if they want to and send you a notice of deficiency. So just important to remember that it's a substance over form rule. So if something if you hear something online, hear something on TikTok and it sounds too cute by half, it is.
Yeah, our rule of thumb, what used to be, if we could think up an answer to the problem within 10 minutes, that it wasn't going to work.
Okay, we don't need to talk about AET.
Yeah, and we just
Okay.
let's take questions.
Yeah.
When you're buying a business that needs real estate or includes the real estate,
Uh-huh.
you're raising investment money, are you typically seeing like there's a hardship for investors and like a different, and then you grow it, how do you recommend dealing with real estate?
Are they buying it together as one business, or are they trying to separate?
Like it's on a bottleneck or something, you know?
So you got two different investor groups for the transaction.
It's not uncommon to see people put real estate in a separate
Yeah,
LLC.
we see that a pretty decent amount.
Yeah, and if you've got just one piece of real estate that the business owns and it's using that real estate, you won't necessarily segregate it. But if it's a real estate investment, you usually will see it segregated. Another plug: do not ever put real estate in an S corp.
No, don't do it.
It's
If
just
you
impossible
get it
to
out,
get
it's
it
gonna
out.
be taxable. Yeah,
It's just impossible to get it out. And even if you plan on holding it forever and passing it down to your children, they get a step up on your death in the basis of their S corp stock, not in the building itself. So it just don't ever put real estate in S corp.
Are there any nuances around that opco conversion that if you are getting a business in real estate as a combo and you want to split them, you should be mindful of as you enter that split for engineering?
It's hard for me to answer that in a hypothetical like that, just because it's so broad, but it's so situational. It just sort of depends on the facts of whatever we're dealing with.
Get it separated on the front end.
Yes.
And if you're dealing with advisors and you know that that's what you want to do, communicate that as soon as possible.
Yeah.
Because a lot of the times, Laura and I, we can structure into most of the things that people want to do with some constraints.
you know,
But
with
if we don't
some
have the time to think through it, it's going to be a lot more difficult.
Yeah, and knowing about it on the front end, we can solve a lot of problems.
You were clicking through the stuff that you said that we didn't even know about.
Come on, Jeff. What do we got?
I read a bullet and it said something about phantom something.
Phantom income.
Yeah,
Okay.
I've heard that term before.
Okay, phantom income means you have been allocated income without cash to pay the tax. So most of the time, and this is something that all of your investors, if you have them, will probably ask for, you'll have a tax distribution provision that says to the extent you allocate income to me, you are going to pay me cash. Usually it's based on the highest marginal tax rate of the
Fed
parties
and
in the
state,
Fed and state of the parties in the partnership, so that they get some kind of cash to pay the tax. That generally does count against what they get in the waterfall.
Just describe pass-through entity
Okay.
versus non-pass-through entity.
Okay, when we say pass-through entity, we are referring to the entities whose income, gain, loss, deduction are all allocated eventually to your personal tax return. Whether that's on a K-1 that's reported to you because you're in an entity with multiple people in it, or you have a sole member LLC and it's going directly on a Schedule C on your 1040.
And what is an example of a non-pass-through?
C corporation.
Yeah. So the only entity that is for federal purposes, that is a tax-paying entity is a C corporation. You will have some states that will have entity level taxes on pass-throughs. Texas has a franchise tax, for example. All right.
Yeah, so we mentioned that can't be the opposite.
Yeah.
That changes.
No.
It doesn't.
Profits interests are a form of ownership in a partnership. So profits interests are a way to get employees compensatory interest in your partnership without it being taxable upfront. So there's a difference between a profits interest and a capital interest in a partnership. They are both considered ownership interests in that partnership. But a profits interest doesn't get paid in the liquidation waterfall until everyone else has received their capital back. That's why they're called profits interest, because you don't get anything until technically everybody else, the value of the company has exceeded what it was in the date of issuance. It is still an ownership interest though. And so if you've got that situation, it can help.
And then
So what you do is we form two entities under the partnership. We check the box on one of those entities to have it treated as a C corporation. And then that entity, the C corp, will own 1% of a new LLC that the operating company owns 99% of. They'll be employed by that regarded partnership underneath the operating partnership. And then you'll have a little bit of tax leakage in the sense that you've got a 1% interest going into that C corporation. So you'll have a tax return there. But it's the easiest way to fix it.
That's the easiest way. Now, the way you can do it is make your employees set up S corporations and
Yeah.
issue the equity directly to
To their
their S corporations. So
But then they have to.
yeah,
it's
that's
depending
depending on how many people you have. It's a lot more.
Yeah, if
efficient.
you've got a large employee base, you're gonna wanna just form the payroll entity center.
You played around volume with, people working with SQL, like asset like businesses, trying to maintain all the stock, and then, potentially, transfer back.
No, because I'm not sure how that would be efficient in any way.
Same with you don't have
You're saying generate a bunch of losses in the C corp? Okay, I'm sorry, I'm not following you.
Anything else? Sam, what you got?
Everybody's really quiet.
Hey, you know what? Oh, go ahead.
What are the advantages and disadvantages of fast versus non-fast?
So, I mean, if you're going to own a business in which you're taking the cash out regularly, most of the time, a pass-through entity is going to be more tax efficient because you don't have that additional layer of corporate tax. It's not always the case, which is why we're saying this is something you should work with an accountant on the front end. It's going to depend on your long-term goals and how you think your business is going to go. Like tech startups, for example, almost always C corporations because they generate tons of losses in the front end, and their whole goal is to go public or sell to another C corp. So they don't care, right?
And it's more than you think in our world,
Mhm.
because what are we using to fund the lion's share of the purchase price? Debt. So
Yeah.
debt strips out a ton of the cash in the early
Yeah.
years because you're trying to pay it down.
Yeah. To the extent, okay, this is probably getting into the weeds too much, but to the extent you've personally guaranteed debt in a partnership that is basis to you, and you can take out cash to the tune of that debt, tax deferred. It's not tax free because when you sell it, you're going to recognize it, but
And you cannot do that.
there are
in a corporation.
benefits. You cannot do that in an S corp. Yeah, there are some benefits if you've personally guaranteed the debt, you do get a tax benefit from that.
You get like a super cursory high level, say equity deal one person buying this and the risk like of not doing that selection by not doing that reorg, if the selection got
Yeah, honestly, it's just a diligence issue at that point. I'm gonna want to see a whole lot more stuff from the seller, and I'm gonna ask for a ton of representations in that purchase agreement, such that if they are wrong, they have to pay you. Now, the indemnity is only as good as their ability to pay you, so there's obviously a risk there. But if you've got an individual buyer who wants to buy into an S corp and we can get comfortable the S selection is good. Worst case, you bought a C corporation if you end up being wrong.
I've blown an S election before.
I wasn't going to tell your war story, Sam.
It sucks because if you want to pass through, you want to see corp.
Yeah.
You were supposed to technically be paying corporate double tax and you made a distributed dividend. So there's all these things. And you can clean it up, but I'm trying to get to a conclusion there by admitting my sins, which is.
They bought an S corp with an MD. Right.
And so, when do we call? Because we are all now both scared and confused.
Perfect.
Here's
our contact information right here.
Here's how you call us. So I like to work with people as soon as they're under LOI. I like to know what your goals are up front, what you're trying to accomplish, what your structure your seller's in, what conversations you've had with that seller, and what education we might need to do with your lender and your seller to get you what you want. And that's where we work together. I'll structure the transaction. He can tell us exactly what it's going to cost. For oftentimes sellers want to know what their primary concern is. Okay, you want to do this deal that's going to be taxed as an asset acquisition. I really thought I was going to sell stock. Like, what does this mean for me? To the extent they have a bunch of hard assets that they've been depreciating, the bill can be different. If it's a service business where 90% of the asset base is goodwill, that's capital gain anyway. There may not be any difference to that. So those are things that we like to assess up front because sometimes if you can get the seller comfortable very early, the rest of it is just a bunch of legal forms to them. They don't care.
Yeah, from a CPA perspective, completely agree with all that. Around the LOI on the buyer side, if I'm dealing with sellers, I know we aren't here on that, but I want to talk to them even earlier. because that can just sidetrack a deal. Like,
Yeah, I mean, the one that Matthias was asking about is a perfect example. The sellers thought that the buyer was gonna buy into their S corp, and he needs to do it with an entity. He's got 4 or 5 investors. He cannot buy in as an individual, and so we're sort of at an impasse. What do we do?
Say, I'm a huge Alabama football fan, and
Toddy toddy.
As I say, you're dealing with an Ole Miss fan up here too, so.
Sorry for your loss.
I'm sure there's someone. Is there any idiot in Tuscaloosa that can handle this?
What was his name?
Yeah, he said if he's an Alabama fan, which one of us is taking the deal? So we tag team, we work together, we have different skill sets. So
Yeah.
but yeah, I was trying to say the hourly rate for you, but I said just true.
There's a little bit of a premium in there.
So tactically, we're out there bidding on companies
Mhm.
using an LOI.
Yeah.
Do you need to talk to Laura? Well, probably not.
No, not before LOI
If
necessarily.
you're using competent M&A lawyers,
They will know
they're
these
gonna
things.
help you issue spot. Which
Yeah.
is to say, the standard protocol is you make an offer to do an asset acquisition.
Yes.
You have a conversation with your seller, the broker, your lawyer around the primary issue of an asset purchase is the customer contract.
Mhm.
And if that if it becomes an issue, and then you realize you need to potentially switch to a stock deal, your first question is it an S corp?
Mhm.
And if it is, then you know you have a problem. You call.
Yeah. You don't need to call, I wouldn't say you need to call us pre-LOI. Unless, I mean, if you're selling something, you might want to talk
Call
to
me if you're saying
pre-LOI.
something pretty
Yeah.
What common mistakes or problems do you see, like, first researchers do with other offers? Like, just be in advance.
Be as specific as you can in your LOI. If you tell a seller that you're buying their company, they're going to interpret that as a stock deal. That's the one mistake I really see. The most people don't understand that the seller is interpreting what they've written in their LOI as stock, and then the seller is viscerally reacting to them wanting to do an asset deal. It feels like a walk back to the seller.
There would be like a case for using something like you with brokering on the job.
Absolutely.
Yeah, absolutely.
Or
But
seller, who's your counsel?
who's your counsel? Like, you need to know that up front. Who is your counsel? Introduce me to your lawyer, because if they've hired competent M&A counsel, that's a lot easier for us to work with than having a huge education campaign with someone who's not ever done a deal before. And we do see it. They want it's constant. Like, most of the time they have their family lawyer that they've used for everything, including like their trust work and their divorce, and maybe they adopted a child. They use this attorney for that. They're like, oh, I'll just give it to this guy, and the guy has no idea what's going on.
So I have a client that has that right
Okay.
now. Like, so what we do to walk it, she keep it. So I guess the question is circling around is, should we be asking them directly to understand the tax bill is going to be process is something that
If they don't know, that's the question that I like, just to make sure that they understand.
I think the way I would ask that is, who's your counsel? Do you have an accountant that's been working with you on this transaction? And then if the answer to that is no, I think it kind of tells you everything you need to know. They have no idea.
And even when you're dealing like,
I would say, my own counsel has people they can recommend, they can work with, it just offer to help. Offer to help them find competent assistance. They,
This is where.
This is-
This is a proxy for how hard the case is.
yeah, I was about to say, I think at that point, it's, if one of us is right, if one of us and lawyers for maybe offer for us to talk to their attorney. And if we still don't get anywhere, it's an indication the deal's gonna be tough slut.
One last question, not softball. Well, you work on deals at SB Libraries, it's to say it's like Clear Books Law or someone else where they need to execute it. Will you take those on or?
No, not really. We're too busy. Like, we're just, honestly, I thought, yeah. We just got more work than we can handle right now, which is a great thing, but
I'm happy to help.
Paul will. Of course, you got to pay the alloy of the tax, so keep that in mind.
I've got an EIA question.
Sure.
We did an asset purchase last year.
Okay.
And we did not want to lock the boat in the customers. So we didn't really announce the purchase to anybody.
Okay.
We did not send out like a retail design to the EIA.
Yeah.
How bad did I mess up?
Well, have they been issuing things?
You're going to jail.
There could be things that matter. There may not be a big deal at all. It sort of depends. Have they been?
What I'm concerned about, so we closed in July. I'm sure the seller got the 1099s, right, for sales I happened after July, right?
Okay.
Does it matter?
It might. Classic tax lawyer. We'll talk about it. Yeah, I just need a few more facts. Gonna need a few more facts.
We don't want discovery to come into the board.
Need to. That is a privileged conversation, friend.
Probably gonna talk to them.
Yeah.
Awesome, y'all. Thanks for having
Thank you
me.
very much.